Hey everybody, this is Ryan Mallory and we're going to do a stock market update. Now I know I usually do these for on the weekends, but not going to be able to do that this weekend, so we're going to do it a day earlier. We're going to go over what the market's done so far this week and we're going to start looking towards what's happening going forward. There's a lot of divergences happening out there, lots to be scared of. A lot to be scared of. Now I know you're going to say, Ryan, stocks only go up. Ryan, money printer go burr. Guys, that doesn't mean anything. It has zero implications on the market. These little fancy cliches, get rid of them. They'll only hurt you guys in the long run. Let's get back to reality here, okay? Because guess what? There's a stock market in front of us. We're starting to see some heavier sell-offs than what we've seen over the past 8-9 weeks. We're starting to see a little bit of a crack in the armor. Let's see where that wants to take us in the days, weeks, and months ahead here. First off, the S&P 500 still has the bearish wedge fully in place here. It confirmed 2 weeks ago when we had the 188-point sell-off on the S&P 500. We had another big sell-off yesterday, not to the same degree, still pretty impressive. It was almost 100 points at one point intraday before it got a little bit of a bounce. What you need to be watching is this 200-day moving average. Yes, we closed below it when we had that major sell-off 2 weeks ago. However, every retest has resulted in a bounce off of this 200-day moving average. On the weekly chart, you see the same thing here. You have a 50-week moving average that's pretty close to the same thing as a 200-day moving average. Not quite, but pretty close. It's been bouncing. It's been holding that moving average here. It has yet to close below it on a weekly basis. It's broken below it, but it hasn't closed below it. And you can see there's a huge convergence of moving averages there. Now, I talked about divergences. What kind of divergences are we seeing out there? For one, the Nasdaq. The Nasdaq is shooting higher. Why? It's not because of all the stocks in the Nasdaq are going higher. It's not. It's because you have a handful of stocks that are moving higher. You have the semiconductor sector. They continue to show a lot of strength here, as you can see with SMH, right? SMH, it's still holding this long-term trend line, barely. It's been consolidating more so over the last few weeks, but it's held the trend line off of the March 23rd lows. That's important here. However, when you look at the QQQs, it's even more bullish than the semiconductors. It has yet to bend the knee to this market. We had one down day yesterday, didn't even come close to breaking the downtrend. Tested it today, it bounced. Another rally like today will probably be sitting at all-time highs again. Here's the thing, and I've talked about this in other videos before. The market is dominated by 5 stocks, namely. You have Facebook, Amazon, Apple, Google, and Microsoft. Apple by far is the strongest, then you have Amazon right behind it, then you have Microsoft, then you have Facebook, and then Google at the tail end of it all. These stocks are not going down at this point. They continue to lift the market up. These 5 stocks, they're worth about 25% of the S&P 500. There's 500 stocks in the S&P 500. These 5 stocks comprise about 25% of it, even more so on the Nasdaq 100. That is why it is so difficult for this market to go down, because they're being seen as a flight to safety right now. That's what the traders are going into. Market goes down, you see the small caps drop, you see the financials, and you see the energy drop. What happens? You see them go right back into Facebook, Amazon, Apple, Microsoft, and Google. Yes, Netflix is good, but it's not like these other stocks. They're not nearly as big. Big, but not as big. So what you saw 5 weeks ago when the S&P 500 dropped 188 points, and what you saw yesterday when the S&P 500 dropped another 80 points, was a situation where not only did the small caps, financials, and energy drop, but you also saw the tech stocks drop. The tech stocks, they tried to hold up early on, they gave way. Very similar price action, not to the same extent of what we saw about 2 weeks ago on the S&P 500. However, on Thursday, you saw the market rally very strong in the final hour of trading, and that's because energy and financials led the way. Tech was slacking a little bit there. However, when tech and energy don't play, that's when everybody puts their money into technology. So in order to get any kind of a sell-off to cooperate, you need to see both the financials, energy, and tech all sell off at the same time. And then you'll get the small caps to follow suit as well, and then you actually get a broad-based sell-off. But until then, you got nothing. Now granted, in the Nasdaq, the strength is impressive, but it's also broken its rising trend line there. It's riding the underside of that rising trend line. Usually that tends to break it further to the downside. But as strong as that chart has been of late, there's a huge divergence going on with the S&P 500. The S&P 500 has broken its bearish wedge, and it's showing a willingness now to challenge the 200-day moving average. The 200-day moving average has to break. If it breaks the 200-day moving average, it's going to go back down and test the 50-day moving average. That's where that one has to break. And then you start seeing a possible move below 2,800. However, on the Nasdaq, it's not even the same picture, because the Nasdaq can't even break the 20-day moving average yet. 20-day moving average is key support for the Nasdaq going forward. You break that, not only break it, but you got to close below it. You do that, then you start seeing more of a bearish picture start to unfold on the Nasdaq. Now zoom in a little bit closer here on the S&P 500, and what you're going to see is 8 out of the last 9 days, and until yesterday, 8 days straight, the S&P 500 is fading every move that's taken place. So if the market opens up in the green, it's going to close lower than where it opened at. And if the market opens lower, it's going to close higher than where it opened at. It fades the opening price every single day, except for yesterday. We saw that again today, and we saw 8 out of the last 9 days that preceded it. Now you got Jim Cramer, the bozo at CNBC. He's saying, "Oh, I love this Jay Powell guy. He's unbelievable. He's just really taking care of the economy, and Jay, we trust. Don't fight the Fed." That only goes so far. We have to go back and ask ourselves, every time we have a sell-off, what happens? 2 weeks ago, Fed announced that it was getting ready to start buying corporate bonds. What happened today? Oh, we're going to relax the Volcker rule here. Guys, every time we have a massive sell-off, we get some more Fed intervention. It's almost like they have a laundry list of things. Okay, once we get this sell-off, we're going to do this. If we get another sell-off, we're going to do that. Hey, we get a third sell-off, this is what we're going to do. Before you know it, they're going to be mandating that Congress gives tax credits for us to go buy SPY. But why is the Fed doing this? They're scared. Look, you can't say don't fight the Fed and the American economy's coming back. Because if the American economy is coming back, the Fed's not going to be doing what they're doing. The Fed is scared. The Fed is scared of one little sell-off. One sell-off, guys. Every time we have a sell-off, boom, we get another program. We get more intervention. We get a new rule that's being relaxed. The economy is not doing good. COVID rates are spiking through the roof again, guys. Don't sit back and think that everything is just going to go back to normal. It's not going to be normal. It's not normal right now. For Pete's sakes, we have a sandstorm coming from the Sahara Desert across the ocean, and it's going to hit us in the United States. What is going on, 2020? You can't make this stuff up. And you'll probably have some murder hornets that are just like swirling around in that sandstorm too. God help us. Now back to the SPY weekly. You still have the major resistance level that price cannot get back above. It's tried to do it intra-weekly, but it can't close above it. Friday will be key for it. If it can close back above this, it kind of makes a much more bullish market going forward. But if it continues to stay below it, it's going to be a lot more bearish in the weeks ahead. Again, just like the daily, you also have the bearish wedge that has confirmed on the weekly, even more pronounced. But now let's go back to the S&P 500 SPY 30-minute chart, because this is what I saw unfold yesterday, and I still think this is a big area of concern for the market. You have a huge sideways channel. I call it a box. You have a box that the S&P 500 confirmed a triple top with on the 30-minute chart, also on the hourly chart. It broke below it. It rallied right up to it today, and that's where it closed the day off at. That's what the market likes to do. It likes to go back and retest broken support. It did that today. Whether it can climb back into that channel, let's hope it doesn't, because you want to know what? We get more sideways price action. That's all we've seen for pretty much the entire month of June. You don't want more sideways action. You want direction. The market's not giving us a ton of that right now. When it broke out of that sideways channel, that was actually a good sign for the stock market going forward, that maybe, just maybe, we might have a little bit of direction going forward here. And if that resistance overhead holds, you can see now where the support from the 15th of June is a key support level for the stock market. If you break that, then you just have a ton of gaps that are left to be filled going all the way back to May 18th, where you just have a massive unfilled gap left out there for us to fill. Now let's flop right back over to the S&P 500's monthly chart. We're still sticking with SPY here. What do you have? You have a monthly candle that's not that far from being red. On the daily chart, we're only about 35 points away between now and the end of this month, which is about 3 trading days left, where you drop a net of 35 points. It's red for the month. The entire month of June is red. I don't know about you, but a shooting star pattern on the monthly chart is not the ideal candle pattern to have going forward. That would mean that 4 out of the last 6 months on the market are red, that we just broke a 2-month winning streak in the stock market following the March 23rd lows. Now I'm going to show you a chart that I don't really show too much. It's called the T2108. It's the percentage of stocks trading above their 40-day moving average. What you have here is you literally have only 52% of stocks trading above their 40-day moving average. You have a Nasdaq at all-time highs, and you have the S&P 500 that has had one of the greatest rallies in market history going back to March 23rd, and certainly one of the fastest. However, until today, you had a 6-day streak where it kept pushing lower, despite the market having a number of solid days in the green. What does that mean? That means that even though the market keeps trying to push higher, stocks are pushing lower. That means less and less stocks are participating in the market rally that we're seeing in the Nasdaq. It also means that the market continues to get weaker and weaker and weaker. That's not a good sign, because when fewer and fewer stocks are rallying to new all-time highs or to new rally highs, like what we saw back in February, that often means that an imminent sell-off is right around the corner. So what do you do in this situation? Well, you definitely shouldn't be loading your portfolio with new long positions. And you certainly shouldn't be chasing the Robinhood bros into these crazy positions. I look at these new positions that are being taken every day in the Robinhood. There's websites out there. I think you can go to robinhoodtrack.net. I believe that's what it is. In any case, it's going to show you on there what the net changes of the biggest position increases are. And they're all trash. They're all trash. Their stocks that have gone up 30-40% in a day, and then they come back down 30-40% the next day, or even more than that. This is a perfect example. GNUS. Don't be trading GNUS, guys. I had somebody email me the other day. I did a whole podcast off of it. He got in at $9. $9 he got in at, and he lost it all. Went all the way up to $11, and it came right back down. He got out at 2 something. Guys, first of all, that's horrible risk management. You have to manage the risk. If you get into a trade, know where you're going to get out before you ever get in. But the stock market is filled with these kinds of stories right now, and it's costing people who do not know what they're doing tens of thousands of dollars, and it's a sad thing that's going on right now. But further to my point about there being divergences, about we're seeing bearish wedges, we're seeing divergences on indicators of stocks trading above their 40-day moving average. You're seeing the VIX indicator, which I didn't get into in this video, starting to pop up again. You have the S&P 500 significantly lagging the Nasdaq, which is putting in all-time highs, while the S&P 500 is putting in a higher low. All these things are not good signs for the market. Now you can say, Ryan, you're a stinking perma-bear, man. You're just gonna always crap on stocks. No, I'm not, guys. I've spent most of my life being long, but there's also been some moments in my life where I've been in some awful crashes, and I know what these things are capable of doing. And I know that what we're seeing right now is a disattachment from reality. It's riding the Fed's hopes to keep pumping this market higher, think that has a bottomless barrel of cash they can just keep throwing at the market. But eventually that dries up. They can't do anymore. So when the stock market, it's rallied like 40+% off of those March lows. If you're looking, hey, the market's gonna go straight up from here another 40 to 50%, you're kidding yourself. It may still go higher, but we are much closer to a top than we are to a bottom. So I'm not sitting here saying never go long on a stock again until we have some epic market crash. I'm not saying that. I'm saying realize that there's the huge potential for another market crash here. Adjust your portfolio accordingly, because you know something? If that market crash does come, you're going to be quite thankful that you did. You can still keep adding long positions as you see fit, but don't go chasing this market higher. Don't go into UPRO on full throttle and think that that market's going to reward you for it, because you're going to get so emotionally charged at trying to chase the market's gains and the fear of missing out that you're just going to get destroyed, man. And if I had to leave you with one thing, it's going to be the same thing that I leave you with in every single video. Manage the risk. Just do that, okay? If you like this video, please make sure to like and subscribe. I'm putting countless hours into these things every single week, doing tons of research. I watch this market all day long, so it gives me a huge opportunity to be able to share with you my thoughts, my chart readings, and what I'm seeing this market doing, and I'm trying to convey it to you. But I appreciate you guys supporting this channel. I appreciate you guys leaving your comments, good or bad. Throw them out there. Let me hear what you have to say. Thank you, and God bless.